The U.S. dollar trading to the upside here this morning following another hotter than expected core PCE print out earlier today, showing that inflation once again remaining a bit sticky. Here to break it all down and what exactly this means for the FX market, we want to bring in Mark McCormick, TD Bank, a global head of FX and emerging market strategy here. It's great to have you here, Mark. So let's talk about that upside here. We've got another surprise in inflation. Is this going to kickstart another round of strength, do you think, for the dollar?
Yeah, I think this is actually very meaningful. The one thing that's kind of challenging about FX markets is it tends to change its focus very quickly. Correlations change, and it kind of changes what it wants to look at. So for a while, the market's been really focused on the relative growth developments between the U.S. and the rest of the world, where the rest of the world's actually been narrowing that gap. Last 3 months, it just completely flipped, and upside surprises and inflation, which have been generally ignored by the market for most part of the year, has become the most important dominating theme in FX. And what it's doing, it's changing the factors and the way that the market's working, because what we've seen is that global growth was being upgraded, financial conditions were easing, central banks were cutting, and that has actually seen the dollar not really track interest rate differential. So the dollar should have been stronger than it was for months. And now what we're seeing is that inflation is taking over, and it's very strong in the U.S. relative to other countries, particularly in the G10, not so much in emerging markets. But that is now what's dictating the market outcome, which is everyone's focused on, will the Fed cut? Can the Fed cut? But we know that the ECB is going to cut, the Bank of England is going to cut, the Bank of Canada is going to cut. So now we see clear divergence. So inflation is the number one thing that matters for the dollar right now.
And Mark, talk to us a little bit more just about that FX trade-off then, given the current environment right now, given the fact that we could see the Fed staying on the sidelines, we could see activity from other central banks. You just mentioned the ECB cutting here in June, and ultimately what that then tells us about the extent of the upside potentially here for the dollar.
Yeah, it's quite important because, too, there's also, the big elephant in the room is there's an election this year. Yeah. So there's dynamics in the FX market that work through geopolitics. One of the things that we see is that FX volatility is quite low relative to geopolitical uncertainty, the indicators that we track. So what we've been thinking is the dollar, as we kind of come through the summer, should be quite stronger anyway, because we do think the market and the election and all these things should be realized through much higher volatility. I think what's happening is now the Fed's window to actually cut rates, whether it be in September or July, is narrowing quite significantly, which also I think there's a lot of debate. We have these conversations with clients. Can the Fed actually cut in September, just given the proximity to the election in general? And if that becomes an issue because inflation's starting to reaccelerate, or it's sticky, or it's hot, then the market's kind of pricing no cuts. So I think the modalities here, or the expectations of where the dollar can go, is the dollar can get much stronger from these levels, given what we've seen transpire over the last couple of weeks and the last couple of months in terms of inflation, and how the market's now pricing real divergence between G10 central banks and the Fed.
Mark, talk to us a little bit more just about the risk of the U.S. dollar getting too strong, and then what could happen next as a result of that.
Yeah, that's another interesting, we always in finance and markets in general, you have to kind of think of first order effect, second order effect. It's very clear that there was a statement last week from Korea, Japan, and U.S. officials that they are worried about the Korean won, the Japanese yen, and they kind of got the green light to intervene. The BOJ did nothing overnight, which has kind of continued to see pressure on the yen. An interesting part here is the BOJ does not work directly, or they work directly, but the Ministry of Finance controls FX movement. So what you can see here is intervention on the yen. We've also seen how central banks have to change their mindset. Do they want to control the FX rate and allow the currency to not weaken, which is what we saw in Indonesia? Or do we want to let the currency kind of be dictated a little bit by the market and see further currency weakness? So the interesting thing that's happening is if we do get this wedge where the dollar continues to strengthen from now until the election, and even get stronger through the election, depending on who wins, the environment can lead to what, if you go really far with it, there's discussions about a new Plaza Accord that's kind of being reported, that's being discussed, that you could see if Donald Trump wins and Lighthizer is Treasury Secretary, they have had conversations, and there's public discussions around whether or not you'd want to devalue the dollar relative to other currencies that are quite cheap. We do see some intuitive logic in that if the Fed can't cut, given inflation and other central banks cut, and you get an excessive move in the dollar in the next 6 months, and then you have continuation in the dollar if Trump were to win, you can see how you can kind of get to an environment in mid 2025 where the dollar is just aggressively too strong and there is kind of a global push to weaken it.
Yeah, Mark, so the timing of it doesn't sound like that would potentially, if all that scenario is played out, that wouldn't be an early 2025 story. It would almost be a latter half 2025, maybe even early 2026 story. Is that right?
Yeah, that's the first and second order effect. First order effect is the macroeconomics, right? It depends clearly on if there's no Fed cuts, U.S. economy is generally reaccelerating. And if the environment is risk off and higher inflation, that does favor Donald Trump and it doesn't favor the incumbent. So in that environment, the markets kind of have to recalibrate to new macroeconomic potential policies, or at least price in the risks, which is tax cuts and tariffs, which are things that have been discussed quite frequently. So those are inflationary themselves. So the entire outlook if you think about further corporate tax cuts or extending those tax cuts next year, along with tariffs on other countries, that also would reaccelerate the strength of the dollar that would come through in the fall. So those are things that would be the first order effect. And in that environment, the dollar gets aggressively stronger in 2025, which then sets up the potential for policymakers around the world to say, the one thing that we do know is if the dollar is very strong, it's bad for global equities, it's bad for global growth. And that's an environment where if the dollar gets excessive based on those type of scenarios, that's where, the second order effect is some kind of policy move.
Mark McCormick, great to talk to you here this morning. Thanks so much for taking the time to join us. Mark McCormick, TD Bank Global Head of FX EM Strategy. Thanks so much.
Thanks for having me.